What is going on with DraftKings stock? You can see DraftKings stock is trading at a 52-week high here at $38.74 per share. That's up from a little bit less than $16 per share 1 year ago. And one of the reasons why DraftKings stock has done so well is because the company has done well. The performance has been incredible. So in this video, I'm going to share with you the highlights, the reasons why DraftKings stock is up so much, especially in the last month or so. And it has a lot to do with what happened in the most recent quarter. So let's get right into that.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So here I have DraftKings CEO Jason Robbins talking about the company's latest quarter and the forecast for 2024. And a lot of what he said, investors liked. And for that reason, the stock price responded to these forecasts from the CEO and a bit of a strategy discussion as well. So let's look at this. So starting with this, the CEO saying that the core value drivers are acquiring customers efficiently, retaining and monetizing existing customers, entering new jurisdictions, and building an efficient and scaled organization. What's new here, what's relatively new here, is the use of the word efficient. Two times the CEO uses the word efficient. And that's something that investors have really been looking for from DraftKings, but not only DraftKings, but many of these other formerly unprofitable growth stocks. Investors have been looking for these companies to grow more efficiently, to grow more effectively, not just spend money on customer acquisition, right? Think about the customers that you're acquiring. Are they going to be profitable? Right? And so in this industry, in particular, the online sports betting industry, out of the many players, DraftKings was the most aggressive in terms of spending for customer acquisition. One of the other ones you may have heard of, Penn National Gaming or Penn Entertainment. Since the beginning, Penn management had came out and said, we're going to go after more profitable growth. We're going to be more disciplined in our growth strategy. That was the opposite of DraftKings. Now DraftKings is kind of coming along the lines and saying, okay, we're going to look to more efficiently grow as well. And so industry wide, now you're seeing that trend where the participants are looking for more profitable growth. They're not just spending aggressively on customer acquisition, and that's good news for industry wide profitability. So also revenue and adjusted EBITDA exceeded the company's expectations, and the momentum continued in the fourth quarter with the start of the basketball and hockey seasons. So not only was the third quarter better than what they expected, but so far in the fourth quarter, revenue and EBITDA are coming in better than expected for DraftKings. So with that confidence, management giving forecast for 2024 of revenue of 4.5 to 4.8 billion, with positive adjusted EBITDA of 400 million at the midpoint. And in my opinion, the most important sentence of all in terms of the forecast for 2024 is this part here. We also expect to generate meaningfully positive free cash flow in fiscal year 2024. That would be the first year where DraftKings generates meaningfully positive free cash flow. That means the business can now be self-sustaining. They don't need to go back to investors and say, we need more money. They don't need to go back to investors and say that. Barring, of course, if at some point in the future the company really emphasizes international growth, because right now they're more of a domestic United States based company, and they've grown to many of the states that they're going to grow to for the near term, right? California is the next big market. I don't think their chances of entering California in 2024 are meaningfully high. They tried in 2022, they miserably failed. And so I don't think they're going to spend millions of dollars again trying to get into the California market. So barring that, they don't have that many more big states to get into, and those entries are what costs the company a lot of money. Every time it gets access to a new state, it needs to spend millions of dollars informing the people of that state that it's now available in their region and for customer acquisition before any of the competitors can acquire those customers of the newly legalized state. That's where much of the company's investment comes from. But one of the reasons why I've liked DraftKings stock is because of that. The spending is more of like a one-time thing where it needs to spend this money up front to get access to a state. And then once it gets access in that state, once it gets those customers, it doesn't need to spend as aggressively to get customers for customer acquisition. Now, there will need to be promotions and incentives to get customers to stay engaged and all that, but it won't be as much as the initial customer acquisition. That's where DraftKings has had a lot of spending going in, and I'll talk a little bit more about that a little later. So in the quarter, revenue increased by 57%, and they achieved the number one combined online sportsbook and iGaming gross gaming revenue share in the United States. So they're the number one market share company in the US in the online sportsbook and iGaming revenue. Now, the market is not that large right now. So the size of the global online gambling and betting industry amounted to $61.5 billion in 2021, according to Statista. This is forecast to rise to 114 billion by 2028, representing an increase of over 86%. Now, while that growth rate is impressive, the size of the market is relatively small. The size of the market is relatively small. This is a small market when you think about a small market opportunity when you think about the global context of total addressable markets. For example, the total addressable market for advertising is over 900 billion, approaching $1 trillion. Similarly, the total addressable market for home improvement is also approaching $1 trillion. So you've got massive markets in the trillions. Travel is another one. Spending worldwide on hotels and travel exceeded 1.5 trillion in 2019 before the pandemic disrupted the market. So this is nowhere near a big market. And so you need to be a number one or number two market share company in this smaller market to generate sufficient returns for investors, to generate a sufficient return on investment. The good news for investors is that DraftKings is generating number one market share in this industry. Another good sign for DraftKings is that the older states that it entered are generating significant contribution profit, and the newer states are generating positive contribution profit faster than previous states. So let me elaborate on that a little bit and why that's good news. Number one, it's good news that it's generating more profit, sure. But number two, and more importantly, it demonstrates a capability. It demonstrates a capability from DraftKings to learn from their growth, from their previous markets, and get better at what they're doing. I like to see that from companies. I like to see them improving performance, getting better at what they do. It demonstrates a capability, and that's something that I like to invest in. I like to invest in companies that are demonstrating capability, demonstrating skill, because ultimately that can lead to competitive advantages. If you're just better at doing something, right? That leads to a competitive advantage. Not just, oh, the market is growing, so my company is going to grow, or this is happening in the industry, and so that's going to help me, right? You're not just relying on industry trends. You're not just relying on growth of the overall market. You're demonstrating skill, and you're beating your competitors, and that's how you're generating revenue and profit. I like to see that. And so now they expect positive, attractive, adjusted EBITDA flow-through percentage on incremental revenue. Well, what does all that financial jargon really mean? What it means is from this point onward, the revenue that the company generates is going to demonstrate strong profitability because they've already invested in the technology. They've invested in the customer acquisition cost. They've reached this scale where now they don't need to spend as much to generate that next $1 in revenue. So when that $1 comes in, a bigger chunk of that $1 will go to profitability because they've built their scale already. They've built their technology, they've built their accounting team, the marketing department, corporate headquarters. All of that investment, that foundation has been built. And so now it's time to reap the benefits of those investments. And all of that has been great news for DraftKings stock investors. And that explains really what's going on with DraftKings and why the stock price is up so much in 2023 and why it's up so much in the last month. I hope you enjoyed this video. It's important not to underestimate the value provided in these free financial analysis videos. To keep the content free, I need your support. All it takes is a smash of that subscribe button to tell YouTube that you want to keep this channel alive. So hit that subscribe button, and thank you for your support.